Two buyers walk into a meeting with the same broker, same business, same financials on the table. One offers $1.4 million, the other walks away at $900,000. Neither one is wrong. They just understand something different about what that business is actually worth and what it can actually support. If you are evaluating a business right now and you are anchoring to the asking price, that is the number you need to stop trusting first. This video is going to walk you through 5 questions every serious buyer needs to answer before any price on any listing makes sense. We call it the 5 layers of business value, and by the time we get through all 5, you will have a completely different way of looking at any deal you evaluate going forward. Welcome to Main Street Ledger. I'm Kurt Rose, CPA, former CFO of an SBA lender and entrepreneur. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. Here's the thing about buying a business that most first-time buyers do not expect. There is no independent appraiser who tells you what the business is objectively worth. There are no comparable sales in the neighborhood. When you buy a house, you have recent sales data, a lender-ordered appraisal, a home inspection, and a title search. Buying a business has none of that by default. What you have is a seller who picked a number, a broker who endorsed it, and a set of financial statements that may or may not reflect reality. The asking price on a business listing is a starting point for a conversation, not the conclusion of an analysis. The broker's job is to represent the seller. Understanding what the business is actually worth is your job, and that requires working through 5 specific questions in order, because each one builds on the last. Skip one, and the whole analysis breaks down. Here are the 5 layers. Layer 1, what does it really earn? Layer 2, can you trust the numbers? Layer 3, how risky is that income? Layer 4, what multiple does that risk deserve? Layer 5, can the deal pay for itself? Layer 1 is, what does it really earn? Before you can value anything, you need to know what you are actually buying. In a small business acquisition, the number that drives valuation is not revenue. It is not net profit on the income statement. It is something called seller's discretionary earnings, or SDE. SDE is the total economic benefit available to a full-time owner. You start with net profit and add back the owner's salary, owner benefits, certain one-time expenses, and other items that would not continue under new ownership. The result is what a working owner can actually take out of this business. For most deals under roughly $2 million, the market prices transactions is a multiple of SDE, not revenue, SDE. So the first thing you need to do with any listing is get the SDE calculation in writing and understand what is in it. An SDE figure built on unsupported adjustments is a very different number than one with clean documentation. The number matters. What is behind the number matters more. Layer 2 is, can you trust the numbers? This is the layer most valuation content skips entirely, and it is the one that protects you the most. Most sellers do not have audited financial statements. They have internally prepared reports, usually out of QuickBooks, and they have tax returns. Those are not the same thing. An audit requires an independent CPA firm to verify the numbers. An internal QuickBooks report requires whoever had access to the software to run it. That distinction matters more than most buyers realize before they are deep into a deal. SBA underwriters, when they are evaluating a deal for financing, lean heavily on tax returns rather than internal financials alone. Fewer people falsify a federal tax return than produce an optimistic internal report. Tax returns carry legal accountability that a QuickBooks printout simply does not. That said, no single document tells the whole story. Experienced lenders and buyers typically look at tax returns alongside bank statements and internal financials together. The goal is to reconcile all 3 and understand where they agree and where they do not. What does this mean for you as a buyer? Before you accept any earnings figure as the basis for valuation, you need to look at what supports it. Ask for an aged accounts receivable schedule. That tells you whether the revenue that was recorded has actually been collected. Ask for an aged accounts payable schedule. That tells you whether any liabilities were quietly deferred to make the business look more profitable in the short term. If the business has equipment or inventory on the books, verify that those assets actually exist and are in working condition. This is not accusing the seller of anything. It is what experienced buyers do as standard practice. Most sellers have clean books. The ones who do not will either provide what you ask for or they will not, and that answer tells you something too. In our HVAC example, The buyer who asks for these documents before accepting the broker's SDE figure is in a completely different negotiating position than the one who takes it at face value. You are not ready to value a business until you know the earnings figure you are working from is one you have actually looked at. Layer 3 is, how risky is that income? Two businesses with identical SDE figures are not worth the same amount if one earns it reliably and the other earns it on a wing and a prayer. Risk is a pricing input, not a reason to walk away. And in a small business, risk concentrates in a few specific places. Customer concentration is the most common one. If a single customer generates more than 30% of the revenue, what happens to the business if that customer leaves? Owner dependence is the second one. If the current owner personally closes most of the large sales, manages the key relationships, or holds the technical expertise that makes the business work, then a new owner is not buying a business. They are buying a seat next to someone who is about to leave. And the third factor is revenue predictability. A business with long-term service contracts or recurring relationships is worth more than a transaction-based business of identical size because the income is more dependable. These factors do not automatically kill a deal. What they do is tell you where the multiple should sit. In the HVAC example, one commercial customer representing nearly 40% of revenue, an owner who personally manages that relationship, and very little in the way of recurring contracts, those are not deal killers on their own. They are signals that this business does not command the top of the market range. Layer 4 is, what multiple does that risk deserve? A multiple is how many years of today's adjusted earnings a buyer is willing to pay for. That is all it is. Higher confidence in the income stream means a buyer will pay more years of earnings. Higher risk means fewer. For Main Street businesses, the market has generally traded in a range of roughly 3 to 5 times SDE, depending on the industry and the quality of the business. But that range is not a formula. It is a starting point for understanding how the market thinks about risk and value. A business with clean books, diversified customers, recurring revenue, and an owner who has built systems that do not depend entirely on their personal presence commands the upper end of that range. A business with the opposite profile sits at the lower end, if it attracts serious buyers at all. Understanding where your target falls within that range requires everything you learned in layers 1 through 3. You cannot skip to the multiple without doing the work first. Layer 5 is, can the deal pay for itself? This is the final test, and it is where a lot of deals that looked reasonable on paper fall apart. Remember that SDE represents the total economic benefit the business generates before the new owner's debt payments and before the owner pays themselves. That is the pool the entire deal structure has to come out of. Regardless of how you finance an acquisition, the business has to generate enough cash after closing to cover whatever debt you took on, keep the business running, and pay you a reasonable salary. If the adjusted earnings cannot do all three of those things, the deal is priced above what the business can realistically support. Think about the HVAC example from the opening. The broker presented $420,000 in SDE at an asking price of $1.45 million. Once the buyer worked through all 5 layers, verified the financial support, assessed the risk factors, and modeled what the business could actually sustain, the picture looked materially different. The business might still be a good acquisition, but not at the asking price. The buyer's job at layer 5 is to work backward from verified, risk-adjusted earnings to the purchase price those earnings can support, then negotiate from that number, not the seller's. The market price and the supportable price are often not the same number. The gap between them is where the negotiation lives. Here are the 5 things to take away from this video. The asking price is the seller's starting position, not the conclusion of a valuation. The same business can legitimately be worth different amounts to different buyers depending on how they finance it, how they operate it, and how they assess the risk. SDE, seller's discretionary earnings, is the number that drives valuation for most small business deals. Revenue is context. Adjusted cash flow available to a working owner is the valuation base. The financial statements behind that number are usually unaudited and internally prepared. Before applying any multiple, ask for the support. Aged receivables, aged payables, equipment lists, inventory counts. This is what experienced buyers do as a matter of course. Risk compresses value. Customer concentration, owner dependence, and unpredictable revenue reduce what a buyer should pay. And understanding the risk profile tells you where within the market range a specific business belongs. The final test is whether the deal can pay for itself. A price the business cannot cash flow is not a good deal at any multiple. Start from what the earnings can support, then work to the price, not the other way around. A business is worth what its verified risk-adjusted earnings can realistically support for the next owner, not what the seller asks, not what the broker presents, and not what a multiple applied to an unverified number happens to produce. We are going to go much deeper on each of these layers in future videos, including how SBA and conventional lenders evaluate deals, how to read financial statements as a buyer, and what real due diligence looks like when you are this close to writing a check. If you want to be ready for those conversations, subscribe now so you do not miss them. Research the deal before you fund the deal.